Good evening, everyone. I hope all of you are doing good and everyone occupied in dedicated fashion towards preparation across all the topics what we have discussed so far. And I can see a lot of messages already floating on the query panel. So good evening, everyone. Kiran, Pratika, Sudhanshu, Komal, Bhumika, Sankaran, everyone. So Kiran, I saw a couple of messages. To be very honest, I would request you to just go through the example of Prachi Limited once again, because that is not at all technical in terms of understanding. It's just that you need to be very much careful about what are the respective days in terms of when the float was, to be considered. What are the check clearing days in that particular week? So I think that is where probably just need to be careful. As far as your other question with respect to paucity of working capital. Paucity simply means that it is a shortage. Okay. Himanshu was asking me about, can you explain how zero balance account is employed for effective cash management? Okay. Himanshu, it is more of a comparative analysis because, imagine that on one hand you have an account which has a requirement of a minimum balance, which is also called as a compensating balance. So there your amount to that extent will be always be stuck. You will not be able to use that amount. Also the effective rate, rate will be higher because you're basically, let's say you are, let's take an example that you're taking a loan of 50 lakhs, but the bank requires you to always keep 2 lakhs in the bank account. So whatever interest you are paying will be effectively on 48 lakhs, not on 50. Like you're paying the interest on 50 lakhs, but the effective rate will be on the 48 lakhs because that 2 lakhs, even if you're paying the interest, you are unable to use. So that's how the zero balance account, where even if you have a zero balance, there will not be any charging any interest to you, and you can easily manage your liquidity in terms of your treasury management, budgeting of inflows and outflows, or what we talked about in the cash budget. Himanshu, I hope that makes sense. Dikshita asking what is float. Dikshita, we discussed different types of float, right? Float is majorly a spread or a delay, and we talked about 4 different types of floats in Friday's session. Okay, I have a quick question now for everyone. I had before, like right in the last 10 minutes of Friday session, I had walked you through couple of approaches to the evaluation of the credit policy, right? One was the gross approach and one was the incremental approach. So if I may ask you, what were the 2 critical points which I told you to be very careful of? We will be starting off with a practical question today, but I want to just quickly do a recap wherein I need to understand that what are the 2 critical points in this regard. Let me see your responses. Darshan says fixed cost, amazing. One of them, yes. Others, guys, apart from the fixed cost, I think fixed cost is something I told you to calculate the existing policy, right? And that will not change in the proposed policy. I think one more thing I talked to you regarding calculation of opportunity cost, right? And in every policy, including the current policy, you would have to calculate the opportunity cost, as in when you are talking about receivables, your money in terms of your cost of sales is stuck. So you have to calculate the opportunity cost, that is amount which is stuck in the cost of sales for the n number of days under respective policy. So I think absolutely correct. Yashika, perfect. So we are talking about 2 things, fixed cost and opportunity cost. Bhumika, perfect. So I think you guys have done your homework, I'm sure. And so time is now that we actually start our discussion with the help of an example here. And again, it will be basically kind of killing couple of birds with the same sword here. We are not only recapping both the methods again, but we are doing it practically today. So a trader whose current sales are in the region of 6 lakhs per annum and an average collection of 30 days. So what would be my current credit period, guys? We're looking at 30 days. That's what my current is, right? And they're talking about sales are in the region of 6 lakhs. So this is important for us. And they want to pursue a more liberal policy to improve the sales. And the study made by the management consultant reveals the following information. Increase in the collection periods. So that means if you like 10 days, that means effectively, what will be my total credit period here? It will be 40 days here. It will be 50 days here. It will be a 60 or it will be a 75 because we are looking at increase here. Of course, we will be talking about incremental approach at some point. So these, like for example, even in the increase in sales, these incremental number will be very, very important. But in terms of total sales, this looks to be 6.30, 6.48, 6.75 and 6.90. I think one thing is pretty interesting is when you can see my increase in sales, very obvious response to the risk of collection over here. What's happening here is that you can see the bad debts are increasing slightly as I'm being more liberal here. So interesting. I think almost the entire information what we need is there. And look at the next para. We're looking at a selling price of 3. Average cost is 2.25. Variable cost per unit are 2. Amazing. Who will tell me the fixed cost here, guys? Who will tell me the fixed cost? What will be the fixed cost? As I said, we are using the same fixed cost as under the current policy. So average cost per unit is 2.25. Variable cost per unit are 2. Let me see who is telling me the fixed cost. Darshan says 25 paise. That's okay. But what is the total amount? What I understand is my sales is 6 lakhs divided by 3. So I'm talking about 2 lakhs units maybe. Out of 2.25. Variable cost is 0.25. Hence 2 lakhs into 0.25 is 50,000. Guys, everyone okay here? Or you could have directly calculated that as well. That's I'm absolutely fine. 6 lakhs divided by 3 into 0.25. That's okay. So we are getting 50,000 as a fixed cost, which will not change. Current bad debt loss is 1%. Mind you, this number present, default, anticipated. These are not incremental. The last column is not incremental, right? So it's like probably 1 is becoming 1.5 and so on. Everyone with me on this? A required return on additional investment is 20%. That means had you not got your money blocked in the cost of sales, this would have been your opportunity cost. And they're saying which of the above policies would you recommend for adoption? So I would like everyone to be comfortable in understanding the question first, and then we will walk through the solution all over together here. Right? So everyone okay with the total sales, guys? How this will be flowing through under different proposals? 630, 648, 675, 690. Everyone okay with this particular first row here on the screen? Credit sales 6 lakhs, 630, 648, 675, 690. Any doubts in the total sales? I think this is pretty much it given to us. And as I said, the average cost was 2.25 and the variable cost is 2. That means 2 by 3 is my variable cost. And that's what we have done here. So variable costs are sales into 2 by 3. So variable cost will keep on changing. 4 lakhs, 420, 432, 450, 460. But as we rightly said, an important aspect is that the fixed cost doesn't change. We're getting 50,000 fixed here. Not only that, the percentage in terms of bad debts changed, right? So for example, in the case of 30 days, we are looking at 1%. For 6,30,000, it was 1.5%. You guys can double check the calculation here. So whatever is given, we are calculating that is as a percentage of sales here. 2%, 3% and 4%. That means your sales minus total cost, that is variable cost, fixed cost and bad debts. I'm getting my expected profit here. We're getting expected profit as A minus B minus C. Till this point, I can see my proposed policy. I think B or C both are doing good, right? Even C is giving the maximum expected profit. Look at this till this point. 144, 150, 153, 154. Right now I'm looking at this. However, we cannot conclude just yet unless and until we calculate what are we losing by providing so many number of days. That's what is important. And hence we will calculate that had my money not blocked under the account receivables, I would have invested somewhere else, let's say in a deposit, let's say an investment, which would have yielded 20% return for X number of days, the days which will keep on changing under each policy. I have to calculate what I lost versus what I gained. And I will see net gain here, net benefit. So that means it's very important that we understand what is opportunity cost here. So for example, what is my cost of sales for 6 lakhs? Guys, cost of sales is probably, I think everyone okay here in an understanding that, cost of sales would be a total of a variable cost and fixed cost. So are we looking at this? The calculation we have already done here. Total cost. These are cost of sales. 450, 4 lakh 70, 4 lakh 82, 5 lakhs, 5 lakh 10,000. This is the money that is, stuck up in the investment. Everyone doing good? So if we have not allowed receivables this much time, this money would have earned some return somewhere else at 20%. So for instance, here 4,50,000 would have been invested for 30 days. So we are doing 30 by 360 into 20%. And we have got 7,500 as opportunity cost. So 4,50,000 into 20% is 90,000, but that's only for 30 days. So 90,000 divided by 12 or 30 by 360 is 7,500. Similarly, for 40 days, we could have invested 4,70,000 at 20%, but for 40 days, the interest we would have earned is 10,444. As we are progressing, by the way, as we are progressing here, my opportunity cost is increasing. That's interesting. Himanshu says, as we're excluding bad debts, we should be calculating the opportunity cost on net receivables, otherwise bad debts and interest. Okay, no, Himanshu, what we are talking about here is bad debts would be out of what is your due, right? Which includes profit also. But Himanshu, don't forget, if you remember, we discussed this earlier also, right? When we were talking about cash cost, when we were talking about working capital, the calculation of opportunity cost is basically focused on the concept of the cost blocked and not the selling price. Bad debt is out of the total receivables, which includes profit element also. So remember, we are not charging the bad debts from the cost of sales, but we are charging the bad debts from the revenue. I think your thought process is right. But I think that's a little point you need to connect. Himanshu, make sense? What about others? Everyone else doing good? So I can see that as number of days are increasing, the interesting point, let me tell you, on the right hand side, I'm doing some small working. I had 4,50,000. Opportunity cost was calculated as 30 days. What is going to change is the horizon is, imagine at the next policy, my cost of sales is 4,70,000, which includes 450, right? I think you all agree with me. 470 includes 450. Additional cost of 20,000. But this entire 470 is blocked for 40 days. Hence, you can see that significant shift and increase in the opportunity cost. Not only additional 20,000, but even the earlier 450. See, logically also, if let's say your customer, your vendor is giving you 50 days time, unless and until we let's ignore the concept of cash discount right now. We'll talk about that separately. Cash discount for early payment. Let's kind of separate that out. A simple point is that if they're giving you a 45 days time, would you like to pay them on 5th day, or would you like to just ensure that you have paid in time? You pay on 44th day, 45th, 42nd, whatever, whenever your payment cycle is. I think probably you would like to utilize the credit period, right? Everyone okay on this? So what I'm trying to explain you here is that it is a very interesting fact that okay, in 4,50,000 your money was stuck for 30 days. For example, if you look at for 75 days, 75 days mein my cost of sales is 5,10,000. Now 5,10,000 is of course inclusive of 450. It is over and above 450 because this is based on the additional sales. But the entire 5,10,000 is stuck for 75 days. And that's what we have calculated here. Hence, I'm seeing my opportunity cost is increasing. But look at what happened here, guys. Because of this additional interest, the proposed policy C, which looked to be very attractive at point A level, is no longer highest. And the highest actually becomes proposed policy A when it comes to the net benefits. We are getting net benefit at 1,36,000 for existing situation. In proposed policies, the highest is proposed policy A, 1,40,000. Then we have 139, 138, 131. It's going down. I think the proposed policy D is actually making the things worse. Because kahan pe you were talking about 30 days, now you're talking about 75 days. That's the opportunity cost. 20% was 20%. It's a huge amount. You're, basically kind of holding of your money for more than double of days over there. And that's why your situation is worst. Everyone okay, guys? In the gross approach, is everyone okay? Now, moving ahead, let's see the same scenario. What happens in the incremental approach? Same example. Same example, what we are looking at in increment. I'm sure all of you already know this, that we are majorly looking at the numbers which are changing. So if I see the incremental approach, you can see the first column itself, which says your incremental sales. The word is incremental expected profit. So you have 0 here and 30,000, 48, the numbers which are given in the question itself. 30, 48, 75, 90. That's what we have. In terms of variable cost, of course, this is my present, so it is kind of a 0. But look at the incremental stuff, 20, 32, 50, 60. This is only on the additional sales, guys. I think this is very much logical also. You can multiply this by 2 by 3. I will get that incremental anyhow. Because variable cost will be varying with the volume, but my fixed costs are actually 0 here on incremental approach. Because 50,000 remained 50,000, mind you. And look at the bad debts. Incremental guys. Of course, even for incremental, you are doing the total calculation, right? I think many of you would prefer gross approach unless and until question tells you to follow incremental. But for incremental also you need to calculate some total numbers anyhow. So for example, the bad debts in the proposed policy, you're talking about 6,30,000 into 1.5%. We are getting 9,450. Existing bad debt was 6,000. So minus 6,000, I get 3,450 here. Similarly, your bad debts under gross approach here were 12,960 right here. 12,960 minus 6,000 gives you 6,960. So these are all incremental numbers, all compared to the present policy. The revised bad debts minus the present policy bad debts. And hence, what I'm getting here is incremental profit, incremental expected profit. And mind you, just like the gross approach, till stage A, when I say stage A, till this point A calculation, the first point, again, policy C looks attractive, isn't it? Again, we are kind of looking at that way that, okay, my policy C looks good till this point. We have not yet considered the opportunity cost though. Now let's see the opportunity cost as well in terms of calculation of a required return in terms of alternative investment avenues. So we had our cost of sales plotted here 450, 470, 482, 5, 510. This is anyways we have discussed in the gross approach. We know the collection period. So what we are doing is based on the number of days we are calculating investment in receivable here. So these are my receivables 37,500, 52, 66, 83, 1,06,000. This is already multiplying the cost of sales into 30 by 360 or 40 by 360 or 60 by 360. And then from C point to D point, we are coming to the incremental. So what is my incremental investment in receivables? 14,000, 29,000, and we multiply that required rate of return to get the opportunity cost. This is my opportunity cost, guys. Incremental opportunity cost. Incremental opportunity cost. We can quickly check that also. Okay. I'm sure many students ask this question, so that instead of doing that way, can we calculate the opportunity cost normally and then can we take the difference? Am I correct? This is what some of you might be thinking. I'm pretty sure some of you might be thinking this way. You can check that. So my opportunity cost under the gross approach under proposed policy was 10,444 minus 7,500. So I'm getting 2,944. What are we getting here? 2,944. Similarly, for the proposed policy B, we are getting 13,389 minus 7,500. That is your opportunity cost under the present scenario, 5,889. Look at 5,889. And again, you can see huge jump as I'm going ahead because my money is being stuck for longer here. And the same logic, guys, the same logic, because my opportunity cost is huge here. I can see that because of this 9,000, this has given way to the maximum net benefit coming onto the proposed policy A 3606. And as expected, I said in the last proposed policy D, things have become actually adverse. And that is what everyone can see here in terms of this negative 5350. Negative under the incremental approach. I think this question was asked by someone on Friday. Manchu, was it you or someone else? Someone asked me that, sir, in incremental, can it be negative? And I said that we will see that in the example, it can be negative. I think someone asked that question to me on Friday, and this is the example in front of you guys. I think that day also I took a random number, but this is a practical example in front of you. That under incremental, you have a negative answer as well. Guys, everyone okay? So if I may ask, which approach you liked? Of course, if the question asks you a specific approach, It's not about your liking, it's about the requirement. But which approach probably you guys are preferring here? Let's see your responses. And I'm sure that this is pretty much interesting stuff. If you know the basics, logics, you should be doing fine here. I'm looking at the query panel to see the responses here on your overall feelings about which approach you are kind of okay. And I'm sure. So the answer is saying gross approach. I think many students prefer gross approach because incremental approach is just an additional step, right? Gross approach wala calculation steps you anyways have to do it. Okay. Himanshu is a very honest answer that less rows are less time. Himanshu, I already told you that even for all incremental, you may not be okay. This is okay that this is step by step just to explain you guys. But instead of these 3-4 rows, you could just have one row, right? You could have just simply calculate the opportunity cost and then calculate the incremental opportunity cost. Himanshu, that is okay. So this is more of a step by step approach to explain the students. But if you were to include that particular incremental approach, the opportunity cost of investments in total first, and then add a second row of incremental opportunity cost, that is also okay. That would have given you the same answer. Swati, that is exactly what I said. That this is just a step-by-step approach. You're asking me what is point D? Point D is incremental investment in receivables. So first of all, you have to understand what is point C then. उससे भी पहले you have to understand what is my cost of sales. So Swati, my cost of sales are 450, 470, 482, but that is cost of sales for the entire year. If my collection period is n number of days, 30 days, 40 days, I have to calculate that for so many days, how much cost of sale in terms of receivables, how much cost is stuck in the form of receivables. So 4,50,000 into 30 by 360, 37,500. How much cost of sales is stuck in receivables when the proposed policy is 40 days? 4,70,000 into 40 upon 360. So I'm getting these numbers here. 37, 52, 66, 83. And the next row number D, which you are asking is basically the incremental. And what is the incremental investment in receivables? Because you are following incremental approach. That's it. And that you are just multiplying. But so instead of having these 5 rows, I am telling you that even in the incremental approach, you could have this row number B here. And then one additional row which could tell you just incremental and use that. Question coming in from Darshan, can we exclude fixed cost row? Darshan, again, even if you're excluding, then you are probably, I would still have that row and include it 0 because anyways you will have to give a note, right? If you're excluding it, then you have to write your assumption that since it is not changing, we are not including it here. I think it's better that you just mention it. I'm sure your answer doesn't change over there. That's okay. Guys, everyone with me on this? Now, one interesting policy or rather method which could be helpful, which is like on the right hand side on the bottom, you can see expected return approach. So here we are talking about evaluation of the credit policy based on the expected return also. Now, what is this expected return? So the formula is incremental profit upon incremental receivables. So what is my incremental profit, guys? What is my incremental profit here? Can anyone do the quick calculation here? $6,550 divided by 14,722. $6,550 divided by 14,722. Right, we're looking at on the left hand side 6,550 incremental profit or incremental receivables. You can use these two numbers. So getting 44.49. Then we are having 9,040 divided by 29,444. You're getting 30.7 and so on. So whichever is giving you the best answer, that is your policy A again. So that is also another way to select which policy is best. Yeah, I think you should just know this expected return approach just as an additional line item for testing. I'm sure they will be telling you what exactly you need to do, but yeah, you need to just know this for matter. I hope everyone okay here, guys. Okay, now we move on to a very, very important section called financing of receivables. Now, collection is really, really a headache for some of the organizations, a risky scenario. You just want to be, following up with your receivables, most of them at least, to ensure that you receive it on time, monitor them in terms of aging analysis. We discussed this earlier. But there are provisions where if you need funds earlier than when you are supposed to, as per your credit policy or when your receivables are supposed to pay, you can probably opt one of these techniques, which can facilitate an early payment with respect to your outstanding invoices. That means you're not allowing them to sit in your account receivable in the balance sheet, but just, have the money today. The only thing is, that nothing comes for free. It definitely has a cost attached to it. So there are two ways to do it. One is pledging and one is factoring. So let's first quickly talk about what is the difference between the two. Now, pledging is more of a loan, right? You keep your receivables as a collateral or a security and you take your funds. Now, what is happening here is, that's what I'm explaining. So in pledging, what happens is that in your balance sheet, you have your accounts receivable, but then you will have a loan here as well. Now, first of all, pledging has a high rate of interest, so it comes with a high cost. But I think because of this scenario, your debt equity ratio will be impacted. Yes or no? Because you have a debt here. However, in factoring, what we are doing here is we are basically looking at an outright sale of receivables to a factor. We are selling the receivables. So we're saying bank to AR. Now the point is, who will be the factor? Is factor a dharmatma for us or factor a godfather who can help us in our times and okay, let us say that we have 100,000, 1 lakh of receivables and they pay us 1 lakh. They are also providing some services, right? So do you think factor will also charge something to you? I think probably yes, some kind of a commission or interest, some service, right? They're taking some risk. They are buying your receivables. Now factors or this factoring is also based on couple of parameters. One, it could be on the recourse basis. So factor can require to replace the receivable. Now what is this recourse? That is there, you in case some customers doesn't pay, the factor can fall back upon the company. You're not taking the 100% risk. That means if some of the debtors does not pay, you can come back to the company and say that okay, keep these debtors to yourself and replace this with another debtors. You're not returning them those debtors, but you are asking them for other customers. However, there could be a factoring without recourse. Now there the factor bears the risk. In case the customer doesn't pay, it is a factor's loss, guys. Now you tell me, if I'm telling you there are two types of factoring, recourse or non-recourse, which would have a higher cost attached, guys? That's a question to everyone. A higher cost attached. Let me see who can answer this. A higher cost, recourse or non-recourse? And probably the reason would be great. Let me see the query panel. I think some students are always on the top of the game. Quick answers coming in from Himanshu, Dikshita, Ritika, Manisha. Yeah, I think I can see majority of you look coming absolutely correct, guys. I think it's obviously non-recourse, right? Where your risk is more. So the factor who's taking more recourse or more risk would definitely would like to charge more commission or higher rate of interest. They're taking more burden on them. Now factor charges commission and interest. I told you this is the risk, but also very, very important point, guys. Okay, commission ho gaya, interest ho gaya. Why commission? For the services. Why interest? Because money has time value of money. They are giving you money before they are due. So interest they will charge. But look at that point. They can also withhold some amount for adjustments. Now you need to tell me what kind of adjustments we're talking about. Why they would withhold? So for example, I'm just taking an example here, guys. Let's say I have an AR of 1 lakh. So they say that, okay, we have a commission of, or rather, let's say, yeah, we have a commission of 2,000. They will withheld around 10,000. So this commission will be deducted. 10,000 is the amount they are, and then probably you are talking about 88,000. इसके ऊपर they will be also charging some interest because that's what they're advancing you. So let's say you are getting, 85,800. I'm just taking an example here. So in this case, my question is, commission is okay, interest is okay, but why that 10,000 was withheld? Why that 10,000 is withheld? They think they can also withhold some amount for adjustments. What these adjustments could be? That is what my question for everyone, guys. Let's see who can respond. Waiting for your responses. Someone says, Darshan says security, Gudri says bad debts, Varsha says bad debts. Okay. But I think bad debts, don't you think bad debts is a risk that is anyways considered by recourse and non-recourse? You are defining your factoring arrangement as a recourse or non-recourse. I'm not very much convinced with the answer of bad debts. Security, Darshan, you are again giving me an answer where I can cross question you that why security? Why do you need security? Okay, I think I'm just waiting for some more responses. Pankan says security. Darshan says 10,000 must be maybe paid after the collection. Darshan very much close. Bhumika says additional charges for replacement. Ritik also saying bad debts. Anyone would like to try? Guys, what if some sales are not final? Example, sale on return or approval. What if there is a debit note or a credit note possibility in terms of price adjustment? What if there are cash discount coming in? Guys, are you getting me? So what if these sales may not be final yet? There may be some sales return, there may be some debit credit note adjustments. So for those adjustments, you are withholding some amount. And of course, Pratisha, you are pretty much not Pratisha, but I think who replied that? Darshan. Darshan, you replied that that 10,000 may be paid after collection. Yeah. So anyway, it is more of a recurring cycle, right? So you may be doing that the business in a continuous fashion. So my point would be that you are of course, once it is collected, you will be paying, but at almost all the times, you will be showing in your balance sheet some amount due from factor. Earlier, you had 1 lakh account receivables. Now you have due from factor 10,000. At all the times, till the time your factoring arrangement is continuing, you may have some amount due from factor. Guys, everyone clear on this? I hope you guys are clear on this, that why we are looking at some amount withheld for adjustments. Okay. Now, similar to what we evaluated in terms of the credit policy, we are talking about should we actually accept a factoring proposal? Now, what I'm looking at is what is the benefit factor providing to you? Factor is providing you the relief from headache of collection. You probably might be incurring some cost for administering, for following up with the receivables, so that cost may be saved. Factors are Kritika, it's not about refundable, it anyways belong to you. So ultimately, if it is a revolving factoring arrangement, they will be paying you, right? Refundable wo hai which they have taken from you. They have not taken you, they have just withheld, right? So yeah, I was talking about that. Okay, think about what factors are providing you. You know, they're kind of saving you headache, they're saving your cost, saving your bad debt. These are benefits, right? Even in fact, opportunity cost is no longer there because you're getting money earlier. So you're probably saving that interest. But what in turn they're charging is your commission and interest. Am I correct? So I think ideally you should compare the cost versus benefit, and if your benefit is exceeding your cost, you should go for it, right? One way to look at it. Also, I think one way to look at it is that if my benefit is more than my cost, that's okay. We say that we should go for it. However, we can also say that, okay, if I'm calculating my benefit or savings minus cost to come out as a net annual benefits, and we divide that by cost of factoring, or we can say that basically we calculate what is the cost of factoring rather than computing as a resulting number. You know, net annual benefits. We calculate the cost of factoring. What we are doing here is that we are saying that a net annual cost of factoring divided by amount available for advance. We are calculating that cost and we are comparing that with the cost of borrowing available outside. That means if we needed money, we did not factor, but we took loan. So if my cost of factoring here is less than the cost of borrowing outside, I can take the factoring arrangement. I can accept the factoring proposal. Let's make sure we understand this. And of course, we normally try to understand things with the help of an example. And I think let's do that itself now. So we're looking at Heaven's company. Has credit sales of 240 lakhs. Average collection is 30 days. Financial controller estimates bad debt losses are around 1.5% of credit sales. So some important information, we are saying sales 240. Collection period is 30 days and bad debts are 1.5%. Firm spends 1,40,000 annually on debtors administration. So we're talking about some savings here. So this would be a saving. Bad debts will be a saving. This cost comprises of telephonic, fax bills and salaries. They are avoidable costs. These are avoidable costs. So that's what we are saying. This is savings. Factoring firm is offered to buy the firm's receivables. Factor will charge 1% commission and will pay an advance against the receivables or interest at 10% after withholding 10% as a reserve. And we think that suggests if we should accept the factoring proposal. Now, in this case, I'm saying that a credit sales is 240 lakhs, guys. And an average collection is 30 days. Can anyone tell me what would be my AR? What would be my AR, guys? Who will tell me the account receivables here? Sales is given 240. I think my account receivables will be 240 lakhs into 30 by 360. Yes or no? So 20 lakhs is my AR, guys. All okay. And if 20 lakhs is my AR, account receivables, if I were to calculate the cost here, the cost, total cost, factoring cost, I mean to say. We talk about savings also. One is the commission here. What is the commission, guys? I think we're looking at a monthly commission of 20,000, right? Because we are looking at 20 lakhs and 1% commission. So can you calculate that? So on a 20 lakh, 1% comes to 20,000. That means 2,40,000 in the year. That is one part of the cost. And what will be the interest, guys? What will be the interest amount? Think logically. So let's say my point is we are looking at 20 lakhs as the AR. And we are talking about reserve. And that reserve is 10%. That is 2 lakhs. We are also talking about commission. That is 20,000. I hope everyone is with me on this till this point. And hence, we are looking at the amount that I will be able to advance is 17,80,000. And this is on a monthly basis. So my interest will be calculated on this. How much will be the interest gain? So we're looking at interest, which is given to us 10%. And that is for 1 month. So we're looking at 1780. See, we could have calculated the total interest also. That's okay. 14,833. Yashika says we'll pay an advance. Yashika, advance here itself basically is what you are providing in terms of factoring services, right? The receivables are not due yet, na? So they're paying you in advance. That's what they mean. So for example, your receivables are due 45 days later, but they're giving you money today. So it's an advance against your receivables and they will be collecting those receivables then. So guys, everyone okay till now? Now, the only thing is what I'm doing is I'm calculating my monthly cost and or probably will try to see what is my annual cost and annual savings. Or I can compare my monthly cost and monthly savings is one and the same thing. So let's say what are my annual cost? Bad debts. 2,40,000. Interest, had I not done on a monthly basis, what would have been the answer? Had I not done 30 by so 1,78,000 into 10% would have been 178. We are looking at 4,18,000 guys. Manisha is not understanding why interest because they are basically advancing you the. So Manisha, if you forget about the factors and go to bank and take the money and you tell them that I will pay you 1 month later, will they charge you some interest? So the factors are giving you money today and they will be getting from the customers one month later. That's the part of factoring here. Now 4,18,000 is my cost. What are my annual benefits? Would be savings on administration. 1,40,000. That's one part. And I think there was a bad debts also, which will be avoided. Bad debt is for annual basis 2,40,000 to 40 lakhs into 1.5%. 3,60,000. So I'm looking at a 5 lakhs of benefits. Now you guys need to tell me if my annual cost is 418, my benefit is 5 lakhs. Should I take the factoring services or not? Himanshu, bad debt is that expense that is irrespective of factoring, right? If you would have not gone for factoring, that would have been your loss, right? So don't mix them up. Don't mix commission and bad debt. Commission is what they're charging from a factor's perspective. Yashika says they're charging commission and interest both for factor. Yashika, okay. You go to the bank, you take money, they charge interest. But generally for loan, do they charge any processing fees, filing charges? You tell me, please. Sudhanshu, please check. I think bad debt should be 1.5% of credit sales in the question. 1.5% into 240 lakhs. Yashika, is it clear? That even the bank would charge some fees, right? So what factor is doing is that factor is paying you money 30 days in advance what you would have got. So they're charging you the interest as far as the financing cost. But since they're providing you those services, they're charging some commission for that. Darshan, I just calculated that, right? Acha, okay. Give me a second. It is my bad. Some people are saying that why 240 is bad debts. I think what I wanted to write was not bad debts, but what was the annual cost, guys? Let me just correct that. It is commission, right? So don't get it wrong. It is commission, not bad debts. Is it okay? Thanks for correcting that, Darshan. Commission. Sudhanshu, everyone okay here? See, annual cost of factoring is commission plus interest. That's okay. I got your point and Darshan point. I think this was a typo. I mentioned bad debts over there. It is a commission, right? 20,000 into 12, right? Everyone okay here? Manisha, Kiran, any questions from you guys? Now, Varsha says commission will be 24,000. Varsha, why commission will be 24,000 now? Guys, please check. 20 lakhs is my AR, monthly AR. I think don't even do that. Na 240 lakhs ka seedha 1% kar lo, right? That would be better. 240 lakhs into 1%, you will get 240,000. So as I said, you could have done a comparison either yearly or monthly. That's okay. We are doing it yearly. Great. Amazing, guys. So I think you guys know your stuff very well. Now I would like to quickly talk about one more illustration. Give me a quick second. But before that, I would like to talk about a small concept. That concept relates to forfeiting. Now, the term forfeiting means relinquishing your right, but it is generally used in the context of facilitating the foreign trade. Now, why I'm saying that it is facilitating the foreign trade is imagine that a person who is an exporter, wants to sell the goods cross border. What is the biggest risk that exporter will have, guys? The risk of collections, yes or no? You don't know the party over there. Am I correct? As an exporter, that's the biggest risk. What if the banking sector comes up with an arrangement that they try to negate that risk? Imagine a scenario where an importer will go to an importer's bank, submitting some papers, for the request for import of goods, and that bank is kind of giving a letter of credit to the importer. That importer is sharing that letter of credit to the exporter's bank. So what is happening here is that now it is between bank to bank rather than from importer to exporter. A simple question is, will exporter gain that confidence now? Will exporter gain that confidence now? But the question is, yes, of course, but the question is then why forfeiting? Forfeiting simply means relinquishing a right. That means basically your exporter is relinquishing the right that, okay, he or she will not be getting the payment from importer now. It will be the bank, importer's bank to the exporter's bank. Right? So basically what we're looking at is that here virtually what is happening is bank buying the receivables from exporter who will relinquishing his right to receive the payment, and that will be the immediate finance to the exporter without a recourse. And what is happening is because you don't have trust, you're looking at overseas buyers arranging for letter of credit from his bank. So basically if you look at the diagram, so basically in terms of an exporter, importer has to draw a letter of credit from the bank. And then with that letter of credit, exporter will approach the bank and bank pays the exporter. And the exporter's bank will be getting the funds from the importer's bank. Yashika says the reserve in the question is for the sales that get adjusted in future. Yes, Yashika. And Yashika, do you agree that probably a factoring arrangement may be in continuation rather than one time? And generally, you will always have that reserve. So like some of you are saying that will it be paid in future? Yes, of course, at some point in time. But let's say if you have a continuous sale, it's happening throughout the year, that probably some reserve for every month would be there, right? Okay. Guys, everyone okay with forfeiting? Everyone okay with forfeiting? Okay, now let's look at one more example with respect to an consideration that should we go in for in terms of liquidating our debtors or not. So on your screens, an illustration which talks about of Abhipra Limited. So the answer is asking letter of credit. It's more in terms of based on the documentation and validation that bank will be giving you a kind of a guarantee, right? That okay, that they will honor the payment, right, on behalf of that importer. But of course, that bank will also be asking the documents and the security from the importer, of course. Ultimately, ultimately importer is paying the payment to the exporter. It's just that the banking intermediaries in between, and of course, they will be charging their services, both the banks are, of course. So Abhipra Limited has a current sales of 18 lakhs. Cost of sales is 75% of sales and bad debts are 1%. This is interesting information. We're looking at a 75% of sales. Bad debts 1%. Cost of sales comprised of 80% variable and 20% fixed. Well, the company's required rate of return is 14%. That's opportunity cost, of course. Company currently allows customers 30 days credit, but is considered to increase the credit. So now we're talking about increasing the credit from 30 days to 60 days. It has been estimated that this change in policy will increase the sales by 15%. So that means if my sales are 100, it will become 115, while bad debts will increase from 1% to 4%. Amazing. So bad debt is 1, which will go to 4%, which is your 4.6. It is not expected that the policy change will result in an increase in the fixed cost. Even if they would have not mentioned, you would be assuming that. And creditors and stock is unchanged. Should the company introduce the proposed policy? Should the company introduce the proposed policy? So what are we saying here, guys? What do we need to compute? Simply, I think what we discussed earlier, that we can probably decide that what's happening in terms of the current policy and the new policy? You want to do it that way, although we could have a multiple ways of tackling that. But what's happening here, guys? If we make a couple of columns, let's solve it together. We are looking at a current scenario and a proposed scenario. So we are talking about sales, which is right now 18 lakhs. But in proposed scenarios like 20 lakh 70,000, 15%. We are talking about a variable cost, fixed cost, and bad debts. I want to quickly check one thing. I think one student was talking about visibility in terms of screen. Guys, can you please confirm everyone can see my screen here, right? So what is my variable cost, guys? Cost of sales is 75% and the 80% of that is a variable cost. So that means 75 into 80 is 60%. So that means 10 lakh 80,000. 60%, right? So 20 lakh 70,000 into 60%. 12 lakh 42. What is my fixed cost at existing level? That will not change. So I think 20% of the 75%, 15%. That is 15% of 18 lakhs. What is that? I think 2 lakh 70. So Siddhi, you need to just check. I think other students have confirmed that they can see the screen easily. Okay, 1% bad debts here. Bad debts 1%. So 18 lakhs into 1%. We are looking at 18,000 here. And 20 lakh 70,000 into 4%. Now that's a problem. Look at my bad debts, guys. From 18,000, I'm taking it to 82,800. So we're getting 18 lakhs minus 1080. Or you could have straight away said that, okay, since my 75% of cost of sales, 25% would have been a margin minus the bad debts, 432. Guys, can you please double check your calculations here? Let me know if you guys agree or you want to change some number here. Please let me know. We wanted to solve it together with everyone. We're getting 432 and we're getting 475 200 right now. Please check. Everyone getting that, the benefit here. I think some people have already given me a thumbs up. Make sure we are not changing the fixed cost though. Darshan, please check. I think I did on sales only. Guys, everyone has calculated bad debts on sales, right? I have not calculated on cost of sales. Of course not. Okay, now we are calculating, guys. The next part is opportunity cost. This is my A. My B is opportunity cost. Now, what is my cost of sales in the present scenario? 18 lakhs into 75%, 13 lakh 50,000. 13 lakh 50,000 into 14% into 30 by 360. Can anyone tell me what are we getting here? 13 lakh 50,000 into 14%. Are we getting 15,750 here? And in the second scenario, my cost of sale will be 12 lakh 42,000 plus 2 lakh 70. My cost of sales in the second scenario will be variable cost plus fixed cost. You're looking at 15 lakh 12,000. Again 14%. But this time we are considering it 60 by 360. Amazing. I'm looking at a 35 to 80. That makes 4 lakh 32,000 minus 15,750. We're getting net benefit here. Guys, please check your calculations parallelly. Let me know if there is any typo. If you want any corrections, I will do that. But you guys have to do, you have to own these answers. Because you will ultimately be doing this practice, right? So this is what we are getting here. 416,250 and 439,920, guys. That means I feel that proposed policy looks good here, right? Net benefit is more, and more by how much? 23,670. You're saving 23,670 here. Himanshu, did you multiply everything by 75%? That I got you, my friend. Himanshu, my friend, I got you. If you multiply everything by 75%, you forgot that fixed cost is not changing. That's why I know some students can do that. That's okay. It's better to be making mistakes here than in the exams. Am I correct? I think, as they say, the more you sweat in the practice field, the less you bleed in war. Am I correct, guys? It's better that you practice. You make mistakes now. Learn from the mistakes. Great, amazing, guys. In case you guys are willing or interested to see an alternative solution, but I think I'm sure you guys like the gross approach better. This is more of a shortcut, but I think shortcuts are sometimes dangerous, giving you the same answer. The only thing is that we are just calculating everything based on the incremental contribution. So I think I would probably ignore this, just that, in case anyone is interested, take a snapshot. But I think gross approach was much more comfortable for everyone. I'm pretty sure that. More than the incremental. This is again an incremental approach. Okay, guys, now we move on to management of payables. Now, I'm sure we all remember that when we discussed started working capital, we all agreed that, okay, in terms of the financing, long term and short term, your payables are a very, very important short term source of finance. And again, liquidity versus profitability. If you delay your payments, it could be a loss of reputation. And then also, of course, any early payment discounts. But if you make payments too early, probably you are stuck. Your liquidity is in question, right? Now, again, we just need to understand what is this payment terms. We discussed this earlier. 2 by 10 net 30. And I told you that this simply means that, okay, my credit period is 30 days. But if I pay it within 10 days, pay the amount within 10 days, I will get 2% discount. The point is, how do I decide whether I should take it or leave it? Right? Whether I should take it or leave it. That means for which I need to know that, okay, if I come, what I'm doing here is, do you agree with me that if I have to get 2% discount, I'm arranging funds 20 days earlier? Yes or no? Arrange funds 20 days earlier. But we are also saying that we are getting 2% discount for that, 2% for just paying 20 days earlier. That means on an annual basis, what would be the benefit here? Or if we kind of decide not to take this discount, what is my annual cost of foregone discount if I do not want to take it? And that's why we need to know this formula and understand this, guys. So look at this formula. We're saying 360 upon credit period minus discount period. So we're saying 360. Credit period minus discount period, that's 20, my friend. That's the 20 days you paid earlier. Discount percentage is 2, but what effectively you are paying is 98. 100 minus 2. Can anyone tell me what are we getting here? I think we are all getting around 36.73. I think very logical also, right? I'm just thinking from a perspective of that if I were to pay 20, I'm getting 2% benefit just for 20 days. I'm getting 2% benefit just for 20 days. Or एक साल में if you are assuming 360 days, so 360 divided by 20. So for a year, it will be 36 plus by the naked eye also. Do you agree with me? Even by simple logic, if paying 20 days earlier, I'm getting 2% benefit. That means annualized impact is 2 into 18. Think it that way. Even without knowing the formula, you know that it will be somewhere around 36 plus. So we need to compare that. Okay, if we forego this discount and actually pay the money after 20 days, that is on 30th day, outside ever can we earn in any other investment portfolio? Can we earn more than this? Let's say the most risky portfolio in market is also giving 28% returns. Even then, this is better. So you can compare this cost of foregone discount. What is with your opportunity cost, with what you could earn it. So let's say if you do not want to take this discount for 20 days, you want to invest somewhere else. But 36.73 looks very huge to me. But let's say I change this number. Let's say that we are looking at probably 1 by, or let's say this is, we will talk about like 1 by 10 net 30. So in that case, what would be my answer? 360 upon 20 into 1 upon 99. So we are looking at 18.18% straight away. And in that case, we can see that, okay, if we are investing somewhere outside, we are okay. If we are able to earn more than 18%, like example, I gave you that outside there is a risky portfolio where you get 28% return. You are willing to take that risk. You are willing to say that, okay, we will not pay you early. We get 20% or 28% return somewhere else. We will wait for 20 days. Guys, are you getting me on this? So that's what we need to know, the significance of this annual cost of foregoing discount. Right? I think Pritika, don't compare that 2%. Think it from an annual perspective. Or if you're comparing 2%, take that annual rate to 20 days. I hope everyone is clear. Okay, so one more thing, guys, it's inventory management. I think this is something you have already done in costing, I'm sure. It's a very, very important element of working capital. And we have discussed this high or low levels of inventory. And we are looking at like Low level means that probably a lot of stock, opportunity cost, not lot of stock, rather, in fact, we're talking about less carrying cost, low levels, and it's a risk of stock outs. A lot of sales we are looking at when we are keeping at a high levels of inventory, but there could be a carrying cost, there could be an opportunity cost. So there are schemes to balance that, minimum or other balance between the liquidity and profitability. What we discussed when we started working capital. Remember my discussion on EOQ, just in time. So one EOQ we have already discussed in cash management also, right? So here also we are just applying that EOQ. This is just for a reference, guys. Some illustrations on the screen. This is just for a reference. Please take a look at these illustrations later on, do your calculations, have some practice. I'm not discussing it here. This is just for reference. But what we are discussing instead is basically some brain teasers before we take a break here. So question number 1 and 2 on your screen, guys. We'll take a break after this. Okay, so make sure that you mention the question number, guys. I'm already getting some contradictory answers for question number 1. I think the key word in the question number 1 is designated post office collection centers. That's the key phrase. So some people are saying A, some people are saying B, some people are saying C, but majority are saying B. Some people are also saying D, guys. Amazing. How come D, guys? Factoring. You're advising the customers to mail the payments to a post office, and you have allied with the banks also. They can collect the payments from that post office box. It's actually called a log box. That's option number B, guys. It's not concentration bank. Concentration banking, you're having different branches and different accounts for different type of customers, and you are telling them those details. Playing the float or factoring is not even talking about collection centers. So 1B, guys, not A. I think most common mistake students do is selecting A. Actually, it's actually B. Okay, what about question number 2, which was, I think, straightforward. I can see a majority Janta here is selecting option number A, which is absolutely straightforward. I think one of the simplest questions probably when we're looking at a gross working capital. The term gross working capital is known as investment in current assets here. Great, guys. So I think it is going well. So what we'll do is after having so much practice in terms of the factoring illustrations and also a couple of questions on the credit policy evaluation, we can take a 10 minutes break here. And once we come back, we will try a few practice questions on overall working capital, whatever we have done so far. So let's continue this momentum. Let's continue this energy after the break. Let's catch and resume within 10 minutes, guys. See you then. Okay, so welcome back, guys. I hope everyone has refreshed and had a much needed break. So we continue from here. Pritika asking me a question here. What is meant by standing order? Pritika, I hope you are talking about in terms of the standing instructions or what? Can you just please confirm? You're talking about in terms of the payments or inventory? Generally, in terms of the banking, you are giving a standing order or instructions. Just like you talk about the utility bill payments, which are like auto debited once you have a man. Like generally, what we do is in these days we have a NEFT mandate form which we fill in. So it's the payment gets automatically deducted. I hope you are asking about that context only. Let me know if there is any other doubt. Okay, so now we are looking at a question, guys. Now this is more or less with respect to what we did earlier. That is calculation of working capital, guys. So let's walk through this together, and we will try to get some hands-on practice in the class as well. And then, of course, it will be over to you guys. So PQ Limited, a company newly commencing business in 2019, has the following projected P&L. So I think couple of important points here. We are looking at a newly commencing business, right? That means probably the beginning numbers are not relevant. So sales, COGS, gross profit, and they're also giving us the other expenses, administrative, selling, and the provision for tax, profit after tax. But I am very much interested in the breakup of this COGS. How it is the cost of goods sold has been arrived as a total material used, wages and manufacturing expenses and depreciation. So we are looking at cost of manufacturing here. And then less stock of finished goods. As I said, because they are commencing business, so beginning inventory not relevant here. So ending finished goods are reduced. Now, very interestingly, but not to the liking of many students here, they're saying that COGS sold figure given in P&L relate only to finished goods and not to WIP. Now this WIP is not leaving us, right? WIP is after our lives. So goods equal to 15%. And that's what you need to practice, guys. WIP related points. Goods equal to 15% of the production in terms of physical units will be in process on an average, requiring full materials, only 40% of other expenses. Company believes in keeping the materials equal to 2 months consumption. All expenses will be paid 1 month in advance. Suppliers of materials are telling 1.5 months credit. Now this could be a very important point here. Sales will be 20% of cash, rest 2 months credit. Rest at 2 months credit. And 70% of the tax will be paid in advance in a quarterly installments. The company wishes to keep 8,000 in cash, and 10% has to be added as a margin of safety for working capital. Of course, we have to calculate the estimate of working capital here. So I think time for some action, guys. Everyone ready here? And let me ask this question right now before we even proceed. How is the Josh? I hope everyone is back. Just let me see how is the Josh? How is the energy? Everyone ready for some real fast action? And I would request your inputs here, guys. Let me see your responses. How active everyone is here. Kiran says Josh is high. What about others? I hope everyone is on in a high spirit, but not of alcohol, but of your hard work. Okay, so let's resume our discussion, guys. What do we do first? First, we are looking at when we are talking about the calculation of working capital, let's focus on current assets first. As we do generally, we are looking at inventory. And in this case, I think we are looking at raw material, WIP and finished goods all. So first, let's talk about raw material. Now, what is happening in raw material, guys? The company believes in keeping the materials equal to 2 months of consumption in stock. I'm very much stuck in this term consumption. What is the consumption? That we need to understand. Pretty important here, guys. I can see the materials used is 84,000. Should I take that as consumption? My concern is there is something which is not mentioned in the P&L, and that is on the top. They have not given WIP here. So this entire discussion, this cost of goods sold, this is not considering WIP. So WIP not included here, but we have to include. So for example, if I talk about raw material, which was given to us as 84,000 materials used. But they are also telling you that 15% of the year's production would be a WIP. Can we say the raw material consumed would be 84,000 plus 15%, guys? 84,000 plus 15%. So 96,600 here. 96,600 multiplied by how many months we are talking about? 2 months. So we're looking at 16,100 as inventory of raw material. Now, I want you guys to be uncomfortable of this. In this context, everyone should be pretty much knowing what we are doing here. You have to own these answers. You have to own these steps. If you feel other way around, let me know in the query panel, guys. I think we can probably proceed to your favorite, WIP. We said 15% of the year production is WIP. Materials are full, 40% of other expenses. So let's talk about materials, 84,000. That's what we did just now, right? 84,000 into 15% will be your raw material simply. Am I correct? Yashika says, please explain this 15% point again. Yashika, have you seen the question on the right hand side, the third line? This P&L does not include anything on a WIP, which is 15% of the current year's production. And in the P&L, the cost of goods sold, that means it's not with respect to WIP, but only with respect to the production, which is complete. So 84,000 materials are only for the complete production. But we are talking about raw materials equal 2 months consumption. Consumption to WIP में भी हुआ होगा, boss. You would have consumed the raw materials even in WIP, the lot which is not yet complete. So that is why we are doing 84,000 plus 15%. That 15% is WIP. So if we talk about this, raw material is 12,600. We talk about labor and overhead. How much is the labor and overhead, guys? Can you please check? Let me see your response for labor and overhead, guys. So what is my labor and overhead here, over here? 62,500, right? 62,500. The most important point is we're saying 40% of the other expenses is only complete, right? That is why it is WIP. So can we say in terms of labor and overhead, 84,000 multiplied by 15% multiplied by 40%? That will be labor and overhead, guys. Yes or no? 84,000 into 15% into 40%. Let me know. Not 84,000. How much? 62,500. What was that amount? 62,500. So let me correct that. 62,500 into 15% into 40%. We are getting 3,750. Himanshu says nowhere mentioned 15% of complete production, and WIP also means production. Then why 15% instead of total production? What are you saying, Himanshu? Have you gone through the first paragraph? Cost of goods sold figure given in P&L relate only to the finished goods. What is finished goods? What do you mean by finished goods? I think if I am not wrong, it means complete production. And next line says goods equal to 15% of the year's production will be in progress. It's clearly crystal mentioned in this particular paragraph. See, I don't want to complicate things. If you are interpreting this in this way, I think probably what you are thinking is probably want to assume something as an X and you are calculating 15% of X is equal to 84,000 plus X, something like this. Why you want to do that? But 84,000 is anyways is a complete production. See, also to your answer, they are using the cost of goods sold by including that amount less the stock of finished goods. Is it okay now? Okay, so everyone okay with the WIP part, guys? 3,750 and raw material. So what is my WIP total is 16,350. Now we move on to the finished goods. So let's see who give me the answer for finished goods. Pritika, it will be 3,750. I think I corrected that 84,000. It should be 62,500, right? I think inadvertently I mentioned 84,000. That is for raw materials. 62,500 is for labor and overhead. You can check the question. Okay, for finished goods, what is the information given to us? I think we probably would not have considered anything. We could have straight away taken 17,000, but I will not take 17,000. They're telling you 17,000 over there, but I will not take that. Because in the 17,000, there is a depreciation also, boss. So I can calculate finished goods in two ways. Either we can do 84,000 plus 62,500 into 10%. Or we are saying 17,000, which is given to you, the closing stock, minus depreciation. Depreciation is 23,500. So 2350. I think both of these should be giving you the same number. Any approach should give you the same number, 14,650. So my inventory in total is coming to be 16,100 or 47,100. Total inventory is 47,100, right? 16,100 plus 16,350 plus 14,650. We're also talking about debtors now. Now, this is interesting stuff, right? This question is interesting. Pretty much reminds you of that WIP illustration we did earlier last week. What is happening in the debtors, guys? Sales will be 20% of cash and the rest at 2 months credit. That's what they've given to us, this number. Sales will be 20% of cash and rest at 2 months credit. And we talk about Cash cost of sales. Cash cost of sales. Now, what is cash cost of sales? If you look at the numbers here, I think looking at everything what is given to us, material, labor, overhead. Now, I would like to talk about one thing, guys. This particular P&L doesn't include WIP, right? So do you agree that cost of production should actually, cost of manufacturing should include WIP? If you think yes, that's okay. But then you'll have to reduce, you will first include in the WIP and then you will have to subtract the WIP. It is one and the same thing. Are you getting it? Probably your cost of goods sold will not change. I may use the WIP numbers. I may have to include WIP in this section, but then I will again have to reduce the WIP there if you want to ignore, rather include in the first section. So I give you two options. You add WIP and then you reduce the WIP because we are calculating cash cost of sales. So even if I don't do that, if you don't include WIP, we just take these numbers. So what are we including here, guys? I think we are looking at material 84,000. Your wages and expenses 60 to 500. What else do we have, guys? I think administrative and selling expenses also, which is 27. So what's this total, guys? 84,000 plus 60 to 500 plus 27,000. Are we getting 173,500 or something else? And what is the stock of finished goods, guys? We are talking about cash cost of sales. So we have to reduce the finished goods stock, which we calculate earlier 14,650. Mind you, selling and administrative expenses were not there. We're getting 158,850. That's the cost of sales. Now, some of you who did not understand the point which I was talking about, I have another option is that I can probably include WIP here. And then I have to include WIP here also. It will be nullifying. It will be nil bata sonata here. I can include WIP in the total cash cost of sales, and then I can include in the inventory also, because then I have to reduce the WIP because it is not sold. Are you getting me? At the end of the day, you will get 158,850. And someone rightly said that since 158,850 is the total cash cost of sales, it's, I think Swati said that. So we'll multiply this by 80% and we'll take 2 by 12. That's what given to us in the question, right? Sales will be 20% of the cash and rest is 80% of the credit at 2 months. So what we're doing is 158,850 into 80% for 2 months. I'm getting 21,180, guys. I'm getting 21,180. I don't know about others, but I think you should be getting 21,180. You can confirm if there are any doubts on this. I know this is a slightly tricky point, but if you think logically, you will understand it. I think there's some problem in the pen. Just give me a second. Yeah, now it's fine. Guys, everyone getting 21,180 here? Can you please confirm the data's numbers, guys? Data's calculation. I'm getting 21,180. I don't know about you guys. So please check. Bhumika, how come you're getting 113,500? Okay, Himanshu, Swati, everyone confirmed. Great. Thanks, Rajiv. Okay, guys. If we are okay with debtors, we are then looking on to the next one, that is your prepaid expenses. So what is the information for prepaid expenses? All expenses will be paid in 1 month in advance. And there's also 70% tax in advance, right? So that means all the expenses means your labor overhead, that is your accrued expenses, and not only that, but your selling and administrative as well. Okay, so let's see that. Your 62,500. Give me a second. Can anyone give me the answer for the prepaid expenses, guys? What should be the prepaid expenses here? Now this is interesting. We are talking about labor and overhead, which is given to us as 62,500. But mind you, that doesn't include the WIP. We'll add WIP onto that. What was the WIP number? 3750. 62,500 plus 3750. So 66,250 into 1 by 12. And then taxes. And then selling and administrative expenses. What was the tax amount? 30,000. 70% of the tax will be paid in advance in quarterly installments. So what is the prepaid tax then? Okay, so it is not 30, it's 10,000 first of all. So we're looking at tax also. That is 10,000 into 70%, 7,000 into 1 by 4. And then selling and admin expenses also over there, which is 27,000. That is also for 1 by 12. So what is the total prepaid expenses? So we're getting labor and overhead. 666,250 divided by 12 is 5521. So we're getting 5521. And selling and administrative expenses 2250. So 5521 plus. I hope everyone is getting that number right. 5521 plus 2250 771 plus 1750. So we're getting 9521 here. Prepaid expenses. Prepaid expenses 9521. So I think just double check the calculation. If you're getting the same number, I'm okay. Your labor and overhead. I think don't forget to include WIP portion in the labor and overhead, guys. That's my total expense. WIP portion is not there. So make sure we include that as well. Just waiting for everyone to confirm. Now, I think one thing which is left was cash in bank. So let me write that on the top. That was also given in the question somewhere. 8,000. So what will be my total current assets, guys? 8,000 plus inventory 47,100 plus debtors 21,180 and 9,521 is prepaid expenses. I think I am getting 85,801 guys. I'm getting 85,801. 85,801. Yashika says why we are including labor and WIP. Yashika, what is the total expense this year? In terms of your accrued expenses, material you have already taken in purchases, right? Creditors, not creditors, but yeah, material stock. You will take that in creditors. Material will take separately for creditors. But when we're talking about in terms of prepaid expenses, they're talking about all expenses will be paid in 1 month in advance. So material part you have taken in stock and you will be taking in creditors, but wages and manufacturing expenses only for the finished goods. So the total expense is also including WIP, that is also incurred in 2019. Rishika, it is clear? Everyone okay, guys, till this point? Manshu, Bhumika, Kiran, all doing good. So what we are getting is our gross working capital or current assets is 85,801. What we're looking at is now calculation of current liabilities. Swati, again repeating that we are talking about all expenses incurred during the year that will be paid in 1 month in advance. So this particular the expenses you have shown in the P&L on the right hand side, they mentioned that is not including the WIP part. So there were some labor and manufacturing expenses. Manufacturing expenses could be your utilities also, which were paid 1 month in advance. So you have to include that as well. Okay, what about the current liabilities, guys? The supplier of materials will extend 1.5 months credit. So we talk about calculation of creditors now. So my question is, how do we calculate creditors? That's interesting part. For creditors, do we need to calculate purchases? And how do we calculate purchase? We have consumed with us. We have ending stock with us, ending inventory with us. Do you agree that we need to add these two to get the purchases? Some raw materials are consumed and some are in the inventory. Yes or no? So that means if I talk about raw materials consumed was 96. What was that? 84,000 plus 15%, right? 96,600. And what is the raw material inventory? Which we already calculated 16,100. Is everyone doing good here? That means we're talking about 112,700 into 1.5 by 12. I think I'm getting 14,087 or on a rounding of number 14,088. Any other current liability which is given to us? Let's see. Can anyone identify any other current liability here? Apart from the current liability, your creditors, or is that the only detail they have given? Any other guys? Just waiting for your responses. Any other current liability we're talking about here? No responses. Himanshu, Bhumika. Himanshu says, wow, Kritika also. They're saying, sir, look at tax. There is a provision of tax for 10,000, out of which they're saying that only 70% is paid in advance. So they're telling me that there is a provision for tax which is left over. That's 3,000. Swati, contingency which we will take care of. We're looking at 17,088 as a total current liability, yes or no? Hence, my current assets minus current liabilities is 85,801 minus 17,088, which is 68,713. And then we are looking at a 10% contingency had to be added. Margin of safety, you can say that. So I think I am getting working capital as 75,584. The only point is, I know this question probably proves to be a question where you wish it or not, your concepts have to be clear. And one of the batches earlier when we were solving this question, some students told me that, sir, our feet are grounded now. We're probably flipping after all the concepts. This question had grounded us safely. This question made us realize that, wow, this is a heck of a question. We need a lot of practice. My only point is, if you look back, are we actually saying a lot of technicality, a lot of complexity here? Or are we rather saying that, okay, there are so much information you need to be careful about, and probably only practice can make it better for you guys? Yes or no? Does everyone agree on this? And this is an amazing question. It's kind of probably touch base on all the aspects: working capital, WIP, concepts of cash cost of sales, how purchases are interrelated to the stock, how we are calculating, including the margin of safety. I think it's probably it's amazing, right? Himanshu says provision for taxes consider all years nothing. Yeah, Himanshu, I know what you're asking. In one of the questions we did earlier, where the provision for tax was same, so we did not take anything, right? So yeah, I think if they would have given you that as a beginning and ending number as a same, then I would agree with you. I hope, Himanshu, you are referring to that example only where you had a comparison of beginning and ending numbers. Okay, great. So I think this is definitely a good question. So let's, I think, move ahead. So a detailed working, I will be again and uploading a different file in couple of days for you guys with all these workings therein. So now we are looking at another question now. Everyone ready for the next one? Just by looking of it, we are moving ahead in terms of analyzing that should we recommend granting of credit to a particular company. Bhumika says, sir, please give a brief of solution because this question is very tough. Bhumika, you need to do a more practice. I would say that probably after the session, do this question once on your own. And in a day or so, I will be uploading a file with the solutions. Like, for example, this slide on your screen is talking about all the solutioning part, what we did. So you will see all that in that particular file as well. Okay, so let's see what this question here is. Slow payers are regular customers of goods dealers, नाम ही slow payer है, and have approached the sellers for extension of credit facility. Wow, we did that today itself. So we are looking at extension of credit policy, enabling them to purchase goods. On analysis of past performance, there is a pattern given to us with respect to the slow payers. At the end of 30 days, 15%, 60 days, 34%. 90 days pay 30, and look at that. At the end of 100 days also some money is paid, and if you add up 1% is more of a bad debt. Slow payers want to enter into a firm commitment. Firm commitment is what? That they will definitely purchase these many goods, 15 lakhs. Deliveries to be made in equal quantities on the first day of each quarter. The price of unit commodity is 150, on which a profit of 5 per unit is expected. It is anticipated that taking up this contract would mean an extra recurring expenditure. This could be important, right? Extra recurring expenditure of 5,000 per annum. If the opportunity cost of funds is 24%, would you actually go for this credit facility? Now, my point is, what is my expected profit here, guys? What is my expected profit in this context? Anyone? We are saying price is given to you 150 and profit is 5, right? So if you're looking at 15 lakhs, 15 lakh divided by 150 into 5, I'm getting 50,000. You're getting 50,000 profit here. Does everyone agree with the profit number? If we actually, so probably what I'm trying to do is now we are calculating the profit from this particular customer, and then we'll talk about what are the costs we will be incurring. What are the costs we are incurring? 50,000 pay, one we are incurring 5,000, and then we have to calculate the bad debts, right? Bad debts is how much? 1%. So for this, we are looking at profit is 15 lakhs divided by your how much was the selling price? We're talking about 150 into 5. So I'm getting a 50,000 profit, but I'm getting some cost here. 5,000 की cost यहाँ पर है, 1% is the bad debt. So 5,000 cost and also 1% bad debt is probably 15,000. So basically I am left with hardly 30,000 to play with, and I will compare that 30,000. What is my opportunity cost? Because I'm not getting these funds in one go. I'm getting some funds in 30 days, 60 days, 90 days. So what do I do? So let's try to understand this. So we are looking at that expected profit is 50, extra cost incurred is 5, bad debts is 15,000, and getting a net additional profit of 30,000 here. Now let us make a schedule together where we will be calculating the opportunity cost. And you know what is the opportunity cost? Amount of debtors into required rate of return. So what we're doing is, in this case, we're saying that mind you, we are looking at debtors in terms of cost of sales. So what is my total cost here? So we are plotting here the total cost. So 14,50,000 into 15%, or how much we are talking about here? What is the total cost, guys? How do we are calculating this? My total cost is 14,50,000 plus 5,000, which is given to us. So total cost becomes 14,55,000. Everyone with me on this? 14,50,000 though anyways from the transaction, and then 5,000 is the total cost. So 14,15,000 we multiply with respective percentages. We are getting 14,55,000 into 15%, we get 280. We get 14,55,000 into 34%, we get 494. This is how my cost is recovered. So look at this. 2 lakhs or 18,000 cost is recovered in 30 days. 4,94,000 cost is recovered in 60 days. 4,36,000 recovering in 90 days. So you are actually, had you not dealt with slow payers, you would have earned this much interest, right? 24%, huge amount. So for every collection, we are calculating separate interest forgone. Why interest forgone? Because you would have earned this interest. So if we add them all up, all the opportunity costs taken together, guys, look at this. My opportunity cost is 68,787, huge. And you're comparing with a 30,000 profit. Kindly tell the slow pairs to become fast pairs. Unless they can relax, you're rejecting their offer. You're rejecting their proposal here. They have to be fast pair in this context. Guys, everyone with me on this? I'm giving 1 minute to everyone to probably look at this. Let me know if there are any doubts on this question. Any doubt from anyone? Okay, great. Let's now look at a bit different question, guys. First of all, I am probably giving you one question which is starting with day limited as a homework, which is basically requiring you to calculate the working capital. So we have already done a complex question already with how to attack a working capital in this context. And I expect you guys to do your calculation. Mind you, what you need to be very, very careful is about the inventory part, raw material, WIP, finished goods. How do you calculate the debtors? I think those are the few parts you have to understand. Creditors will be basically on the context of the purchases. So we'll include the raw material consumed and if there is any ending inventory as well. And of course, so whatever we have discussed, this is very, very similar question because here also we are saying there is a newly opened on the top and they're saying that, okay, net working capital requirement on a cash cost basis. So I want you guys to kind of practice this on your own and then probably you can, calculate and compare your, answer later on. So this is something as a homework for you. Right now, I want to focus on this particular question, guys. Alliance Limited on your screen. A petrochemical sector company had just invested huge amount in its new expansion project. Due to huge capital investment, the company is in need of additional 1,50,000 in working capital immediately. Kiran, we have already uploaded this file, guys. Everyone has seen this file, right? Working capital file, which I have already uploaded. These questions are already there. Can anyone else confirm? And I will be re-uploading a solution, a file with the solution in a couple of days. Guys, I hope you guys have seen this as part of your notes upload. Can anyone else confirm, please? From your login or portal, wherever you access these files from. So Himanshu, Pritika, anyone else, everyone has hand of this file, right? So for just practicing those questions. So all the questions are there in the same file. There's no other file here. Okay, so coming back, we are looking at due to huge capital investment, companies in the need of additional 1,50,000 in working capital immediately. The finance manager is determined following 3 feasible sources of working capital funds. Guys, if you're talking about 3 feasible sources and the requirement is which alternative should company select, I think I would go with the minimum cost, yes or no? Would go with the minimum cost, yes or no? So let's try to calculate the cost of each of the alternatives here. The first one is the bank will lend 2 lakhs at 50%. and 10% compensatory balance will be compensating balance will be required, otherwise which will not have been maintained. So what will be the cost here, guys? Interest is 30,000. Am I correct? Everyone with me on this? The interest be of 30,000 here. And how much money you will be able to use? What will be the amount here which is utilizable? Unfortunately, it will not be 2 lakhs, it will be 1,90,000 if I'm not wrong. 2 lakhs minus 10%. Or rather 1,80,000, right? 2 lakhs minus 10%, 1,80,000. So what is my effective interest here? We're looking at 30 upon 180. Guys, please just double check the. I think we are getting 16.67%. All okay, guys? So we're getting a cost of 16.67% if we go for bank loan. Now, the second one is trade credit. Who will tell me the cost for trade credit? Companies offered credit terms from its major supplier 3/30 net 90 for purchasing raw material worth 1 lakh per month. You know how to calculate the cost here, right? The cost of the trade credit, annual cost. We discuss a formula here. What was the formula, guys? We talk about 360 upon 90 minus 30. That means 360 upon 60 in a nutshell. Multiplied by 3 upon 97. So what's this number, guys? Swati says 18.55%. Okay, so I'm getting 18.56 as a rounding off. Okay, so guys, do you agree just by looking at these two options, I can reject trade credit probably? I can reject trade credit for sure because bank loan is cheaper here. But we are yet to see the factoring though, mind you. We are yet to see the factoring. So let's go for factoring now. A factoring firm will buy receivable of the company at 2 lakhs per month. Shall have a collection period of 60 days. Factor will advance up to 75% of the value at 12% annual basis interest. So 2% commission bhi hai. On all the receivables, it is estimated that the factor services will save the company a credit department a bad debt of 1250 and a credit expense of 1250 and bad debt of 1750. So total savings is 3,000 per month. So how do we say this? My commission is how much? What is my commission, guys? 2% into 2 lakhs is 4,000. For the entire year, it is 48. 48,000, guys. Am I correct? And they're talking about interest also. In this case, they have not given any information with respect to holding. So if I say commission is 48 and my savings is 36, I'm saying my net commission which I have to pay or net cost is 12,000. But there is an interest also, mind you. There is an interest also. How much will be the interest? We're looking at 75% of the money. So 2 lakhs into 75%. Let's say 1,50,000 will be advanced. 1,50,000 into 12% on an annual basis. So I can probably do it 1 by 12. That will give me monthly number. And then I will again multiply this by 12. This will be giving me the annual number. So straight away, can we say that this is 18,000 here? 150,000 into 12%, guys. 1,50,000 into 12%. Because interest we are calculating majorly for the annual, annual amount. We're talking about the annual cost here. So see, I am getting a commission of 48. I'm getting interest of 18. That's 66. Savings of 36. So basically, total cost per annum is 30,000. Everyone okay here? That's the total cost we're getting. And how much is the receivables you basically talking about here? 1,50,000. 30,000 divided by 1,50,000. I'm getting 20% here. So my net factoring cost here comes to 20%. So I'm comparing 16.67, 18.56 and 20%. So what happened was as I progressed, my further options are actually more expensive. So I think this seems that even the factoring goes for a toss, and I think I should select bank loan here. So bank loan is advisable. Guys, all okay? It is giving a couple of minutes for everyone to digest. Let me know, please. Any doubts so far? Okay, give me a second. I think I'm just reading a query by Himanshu. Himanshu says, sir, in one, we are talking what we are giving, but in two, we are calculating what we have. Okay. How we are considering that, Himanshu? Because basically, if you are not going to opt that, what is the cost? That's what we are talking about in the annual cost of foregoing the benefit, na? So even the bank loan you have not taken, you are yet to decide. Himanshu, to your point, it's a good way to look at it. Your observation is perfect here. But what I'm trying to do is that in 1, 2, and 3, you have not done anything. We're just comparing the three options. I think I've got your point. The only thing is we need to understand that in the second point, the company has been offered credit terms from its supplier. That's talking about an 18.56%. So basically, if I would say that in market, you would have got a higher percentage. You would have gone that. But if you're talking about for a lower percentage, why would you go for that? That's what I would say. So if you're foregoing that, you're incurring a cost of 18.56%. Look at that way. Himanshu, is it better now? I got your point. The only thing is we are anyways not doing anything out of three. We're just comparing the three alternatives. That's it. We'll decide accordingly. Good point, guys. Any other questions? I think this is a different question here. Okay, so now, guys, there is one more question, which is like more of a cash budget, and I'm sure everyone is perfect in cash budget, or I think you like that topic a lot. But so basically, we are talking about two questions. Earlier, I was giving you one question for day limited. You have to calculate that working capital, and now one more question, which talks about of a cash budget. But I can just quickly discuss with you, and then you can probably have your hands dirty on that later on by practicing. Probably after the session, it would be great that if you can tackle these two questions today itself after the session, so that since you are fresh right now. So here they're talking about beginning of the January, they've given you the cash balance. You're required to prepare a cash budget. And we are saying that same pattern which we discussed earlier, 50% of the total sales are cash. Asset are to be required in the month of Feb and April. So basically what we're looking at here is, let me just show you these things, right? So assets are acquired in the months of Feb and April. So you should be making the payment of 8,000 and 25,000. So you have to basically be careful about these specific plotting here on the right hand side. We're looking at Feb and April. So which month the asset should be purchased? An application has been made to the bank of loan of 30,000 and they're expecting that will be granted in the month of May. So you get your inflows in the month of May as 30,000. And we are anticipating a dividend of 35,000 to be in the month of June. So this question is all about plotting all the information in the respective columns. That's it. And then debtors are allowed 1 month of credit. Mind you, 50% of the debtors are the sales are cash sales. So they're giving you the calculation for or rather sales for the month of January to June, and you are basically required to calculate the 6 months budget. So if I were to ask you, what will be the collections in the terms of January sales, we are only including the cash sales here. That we're including the cash sales. Right, so what is we are looking at is 72,000. Uska 50% 36 here, and rest 36,000 coming in Feb. Similarly, for the Feb 97,000, cash sales is 48,500 and 48,500 coming in March. I hope you remember that we discussed this a detailed question last week. Calculation of the cash budget, plotting in the collections, plotting in the payments, and they've given you the information for the creditors also. Creditors are also given 1 month credit, and sales commission is 3% paid to the salesman each month. So you have a commission also, that means sales commission. So mind you, this is an important number. Sales commission, you will be multiplying the 3% with every month's sales, because you're not worried about when they are paying you. You're just talking about sales into 3%. And for the purchases, it's very logical that for the January month purchases, 25,000 will be paid in the month of Feb and so on. So I think this is a very, very straightforward question. I just kind of walked you through and advised you that how you need to go about it. But my humble advice is for both these questions, one is on cash budget and one is on the last particular slide, that is your day limited calculation of working capital. I request you all to do this work probably after today's session or maybe in the first half morning tomorrow, so that you are fresh. Whatever you have done, try to do more practice, and why not restrict only to these two questions? Then obviously you have your past year papers, other questions in your study material, and you should go and look for all of them. Well, that brings us to the end of the session here. All good things have to come to an end, and I think I would like to thank you all for the core, from the core of my heart. I think you guys, as every batch, were amazing in terms of participation, in terms of clarifying your doubts. I think each and every one, I think Himanshu, Kritika, Kiran, Swati, all of you, right? I'm sure it was a wonderful, interactive session, Rajiv. So pardon me if I'm not taking all the names here, but I think I enjoyed it. I'm sure you guys enjoyed the series of sessions. So I would like to take this opportunity to wish you all the best of luck. Just continue your, approach, and always remember, guys, there is no, shortcut to success. We are looking at those 3 keywords, hard work, discipline, and dedication, that will always take into account and will contribute to your success, right? So So it's very important that we guys continue the momentum. And I'm sure whenever you feel tired that okay, I'm stuck, all these practice questions, I'm doing so much mistakes, that's fine. I'm already telling you that, you know, more you do mistakes now, more you learn now, better it is for your exams. And always remember, when you feel it's too dark, always remember that there will be always light at the end of the tunnel. So make sure that you have belief in yourselves, continue with the hard work. Don't worry about the result. Result will follow you. You just carry on with the hard work, guys. So thanks a lot. It was amazing session, series of sessions. So wishing you all the best of luck for all the practice, for all the preparations, and for all your future endeavors. Take care, guys. Good night. Take care. Cheers.